Welcome, everyone. We're pleased that you have joined us for today's webinar, The Complex World of MEC. The webinar will last approximately 15 minutes, and at the end, you will be given an opportunity to receive supporting materials by email. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sujas. Linus works for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful law planning practice in Franklin, Tennessee. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Lineberg, and he regularly speaks at industry events. Before I turn the floor over to Linus, we're going to vote on the next webinar. For August, we plan to discuss the Big Beautiful Bill, assuming that it gets finalized. If it is not final before August 6th, we will discuss whatever topic is chosen today in August. If the bill is passed, we will cover today's chosen topic in September. The topics up for your consideration are dynasty trust planning, the tax uncertainty continuum, or asset protection planning, an imperfect guide. I'm going to go ahead and launch the poll, and I'll give everybody a moment to vote. Give you about 20 more seconds to get your votes in. All right, it looks like the next topic will be asset protection planning, an imperfect guide. Thanks for participating in our poll, and now I will turn the webinar over to Linus.
Thank you, Jennifer. I'd like to welcome you all to today's webinar titled The Complex World of Modified Endowment Contracts. We have these webinars. They are free and available to financial planners and life insurance professionals. They're held on the first Wednesday of every month at 11 a.m. Central Time. We invite you to attend next month's webinar when we plan to discuss the final version of the Big Beautiful Bill legislation, assuming that it makes it through the House and Senate and also gets signed by the President. If for whatever reason that bill doesn't get through and doesn't become law, then we'll probably default to the choice that you made during today's poll. But more likely than not, we'll be talking about the final version of the Big Beautiful legislation. That webinar is free and open to all in the financial services business. So if you know of someone that would benefit from attending, feel well to pass word along to them. All right, let's get started on the complex world of MECs. Here's what we're going to talk about today. First of all, we'll talk about how you make a MEC. Secondly, we'll talk about the taxation of modified endowment contracts. We'll talk specifically about loans and assignments of MEC contracts. We'll talk over a few nuances, and then we'll finish with some conclusions about what it is that we've talked about today. So let's go ahead and start with making a MEC. So back in 1988, the federal government decided that permanent life insurance was getting too good. It decided that people were stuffing permanent life insurance policies with a lot of cash in the first few premium years and taking advantage of the tax rules that were available for life insurance. And so they decided it was going to be a good idea to limit how much somebody would pay into the contract during the first 7 years of the policy. And if the policy owner exceeded that limit, then instead of having a regular, normal life insurance policy, they'd have a modified endowment contract. Now, a modified endowment contract is still life insurance. However, it's taxed differently, and we'll get into that in a second. And so the first way that somebody can make their life insurance policy a modified endowment contract is to put in too much premium during the first 7 contract years. In my experience, life insurance companies do keep track of whether or not a policy is a modified endowment contract, and they will allow a person to make their life insurance policy a modified endowment contract. Life insurance companies won't let people exceed the guideline premium limits, so they insist that people limit how much they put in so that the contract is still life insurance. However, the carriers will allow for modified endowment contract status. Another way to make a contract a modified endowment is to reduce the contract's benefits during the first 7 years. The most common way to reduce a contract's benefits is to try to reduce the face amount during the first 7 years. How will that make a contract potentially a MEC? The answer is that if you reduce the face amount during the first 7 years of the contract, the IRS says that you have to pretend that that lower face amount was in effect from the beginning. And so premium that you paid in the first few years before the reduction is compared against the new 7-pay limit for the reduced face amount. And if it was exceeded in the past, then you've got a MEC. And so one of the things that is a tip is to carefully think about any reduction in face amount for a permanent policy during the first 7 years. Make sure that you're not unintentionally making the contract a MEC. And then another way to make a life insurance policy a modified endowment contract is to add to the benefit, make a material change to the contract, followed by putting in too much premium in the subsequent 7 years. Let me explain that a little bit. A material change, adding something substantial to the contract or changing something substantial in the contract, requires that you start a new 7-year premium test. And if you put too much premium in during that subsequent 7 years, then you will make the contract a modified endowment contract. And so changes to life insurance policies that are increases in benefits in particular should be evaluated, particularly if the plan is for the client to put in more premium after the increase, to make sure that the client doesn't unintentionally make the contract a modified endowment contract. So what are the consequences of making a life insurance policy a modified endowment contract? Well, it has to do with taxes. MEC distributions are taxed like distributions from a non-qualified annuity contract, in that distributions, withdrawals, are taxed gain first, right? With a normal life insurance policy, a non-MEC life insurance policy, withdrawals are normally treated as a tax-free reduction of basis first. However, with a MEC, it's the other way around. You get the gain out first and it's taxable. Another difference with MECs is that loans are treated as taxable withdrawals. Again, unlike a normal non-MEC life insurance policy where loans aren't treated as distributions at all as long as the contract stays in force, with a MEC, loans are taxed immediately in the same way withdrawals are, that is, gain first. And also, like annuity distributions, the taxable portion of a distribution from a MEC is subject to the extra 10% penalty tax if the policy owner is younger than 59 and a half. And so, as I said, MEC distributions taxed much like distributions from non-qualified annuity contracts. On the plus side, the death benefit from a modified endowment contract is still income tax free generally when somebody dies. So that is unlike an annuity. Death benefit from a MEC is still income tax free. So let's talk a little bit more about loans and assignments. And here's an example that I give that I think drives the point home. The conclusion that I draw from this is that in general, if someone has a choice where we've got a modified endowment contract, that we take a withdrawal instead of a loan. And so here's the reason. Here's an example. Let's say we've got Marvin who owns the universal life policy and it's a MEC. He's paid $100,000 in premiums and the policy's current cash value is $125,000. And so if Marvin takes a partial withdrawal, that first $25,000 of gain is taxable based on the gain first distribution rule. And if Marvin's younger than 59 and a half, he's going to pay the penalty tax on that distribution unless an exception applies. And that's his only tax result unless and until he takes another distribution from the policy. If, on the other hand, Marvin takes a $25,000 loan against the contract, he's going to pay income tax just as he would on the partial withdrawal. However, if, like most of our policy owners, he lets the loan interest accrue against the policy, that annual interest accrual is likely to be another taxable distribution against the policy. And the reason for that is the policy is going to earn interest on its cash value while the loan is out there. And that's going to make the cash value growth taxable because the loan is also growing because of the loan interest that's accruing against the policy. That's going to cause an additional taxable amount also potentially subject to the 10% penalty tax. And that's a result that most of our clients will want to avoid. And so the punchline there is what I said. From my perspective, the best way to take distributions from a modified endowment contract are by partial withdrawals because the income tax result is predictable and short term, whereas distribution by loan will have a potential long-term income tax effect and potentially one that can be hidden from most of our clients unless they've considered this issue in the way that we just have. Another observation is this, and that is the collateral assignment against a MEC life insurance policy is thought to be legally equivalent to borrowing against the contract. And that means a collateral assignment is going to create a taxable event for the policy owner, subject to income taxes on the gain, also potentially subject to the penalty tax on the gain just because the collateral assignment exists. And this is true of bank collateral assignments as well as assignments connected to things like split dollar plans. And so from my perspective, a lot of care needs to be taken, a lot of thought needs to be given if someone is going to put a collateral assignment against the life policy about its MEC status. We want to, if at all possible, avoid putting a collateral assignment against a MEC policy. Let's talk about a couple of nuances with regard to MECs. First nuance is this: when a business owns a non-qualified annuity, the business loses tax deferral on the non-qualified annuity, making it inappropriate in most cases for the business to in fact own a non-qualified annuity. On the other hand, if a business owns a MEC, a modified endowment contract, MEC policies retain tax-deferred growth until there are distributions from the policy. Because of this, businesses that want to put their money in an insurance company's product may be better off buying a MEC life insurance policy as opposed to buying a deferred annuity. It might be a better practical choice. Also, in a situation where there's a trust buying a modified endowment contract, there are a few issues that I think are relevant. First of all, if we've got an irrevocable life insurance trust, it's important to remember that the death benefit payable from a modified endowment contract is still income tax free. So it's not necessarily a problem for an ILIT to own a MEC, because usually we're not thinking that the ILIT trustee is going to access the cash during the insured's lifetime. And so MEC status probably doesn't matter in most of those cases. One other observation with regard to trust ownership of a MEC is that all trusts are going to get tax-deferred growth from a modified endowment contract, even if a non-qualified annuity would not. The reason that the growth of an annuity owned by a business is not tax-deferred is because it's built into the tax code. Sometimes trusts that own annuities will also lose tax-deferred growth. Trusts that own MECs will still get tax-deferred growth. And then on the downside, if we've got a trust that owns a MEC and the trustee takes a distribution from that MEC that's taxable, the penalty tax may always apply to the taxable portion of a distribution, because a trust, if it's taxed on its own, will not reach age 59 and a half, will not get to a point where it is exempt from the penalty tax from a MEC contract. So what are the conclusions that I hope that you take away from today's session? First of all, death benefits for modified endowments are tax-free. Also, accelerations of the death benefit for chronic illness or terminal illness are tax-free from modified endowment contracts. So depending on the circumstances where we're implementing a life insurance policy, MEC status may still be okay. Speaking of MEC status, make sure that where your client is making a MEC, that decision is intentional, and that the issues about taxation of lifetime distributions have been thoroughly thought through. Certainly, my recommendation is to avoid loans against modified endowment contracts, and also to avoid assignments against MEC contracts, because those can lead to unimagined adverse income tax effects. I'd like to thank you all for joining today's session. Remember that we hold this session free every first Wednesday of the month at 11 a.m. Central. If you have an interest in seeing some of our past sessions, you can find them on our YouTube channel.